Back when I was getting into this, I figured RSI hitting 70 meant sell right away, like clockwork, and 30 was the green light to buy. Blew through a chunk of my account that way, didn't even blink at first because it felt so straightforward. But can you really stare at 6 losses in a row from that and not start questioning everything? I mean, I did eventually, but it took a while to sink in. It started with this one trade. I think it was around the dot-com days, everything bubbling up like crazy. I was watching this tech stock, can't even remember the name now, but it was one of those that everyone was piling into. RSI climbed past 70, and I thought, okay, overbought, time to short it. Made sense at the time, right? The book said so, forums were full of it. But the thing kept climbing, ignored that signal completely, and I held on, waiting for the drop that never came quick enough. That loss wasn't huge, but it stung because I doubled down, thinking the indicator couldn't be wrong twice in a row. Except it was, and that fed into this quiet doubt that I pushed aside for months. If I'd paid attention to the momentum behind it, things might have shifted sooner. See, what I didn't get back then was that RSI wasn't just screaming overbought or oversold like some alarm bell. It was more about the push, the strength fading or building under the surface. But I ignored that part, kept treating it like a simple threshold. Led to another mess during that sideways stretch in the early 2000s, market just grinding nowhere after the bust. I spotted this index play, S&P futures I think, RSI dipping to 30, so I bought in, expecting the bounce. Market chopped around, ate my stops, and I ended up out with nothing but frustration. That happened because I wasn't looking at how the lows were getting weaker, even as the price tried to hold. If the divergence had clicked for me then, I might have skipped that entry altogether, but nope, I plowed ahead. This is where it quietly got trickier. I started noticing patterns in my logs, but not right away. It was after a string of those fake-outs that I revisited some old trades. Take that 2008 crash, everything tumbling, fear everywhere. I had this bank stock, RSI way over 70 during a brief rally, sold it short, patted myself on the back. But the divergence was there, hidden in plain sight, price making higher highs but RSI not keeping up like the steam was running out. I didn't see it, got squeezed when the rally extended just enough to wipe me out. That loss chained into the next one because I overcompensated, started avoiding signals altogether for a bit, which meant missing real turns. Like if I'd used the divergence to confirm instead of relying on levels alone, that short might have waited for the actual break. Years later, I skimmed some article that echoed what I'd lived through, talking about how indicators like this measure relative strength, not absolute rules. Matched my scars perfectly, but I didn't need the paper to tell me. I'd already burned through accounts figuring it out the hard way. Anyway, that led me to tweak how I looked at it, not scrapping RSI but layering it differently. What I call my strategy twice secret, I guess. Using it once for the obvious, the levels, but twice by checking the hidden shifts, the divergences that whisper when the crowd's wrong. Remember that hype around electric vehicles a few years back. Stocks shooting up on every rumor. I had this one position, RSI blasting past 70, overbought city. Old me would have sold immediately. But because of those past blows, I paused, checked the momentum trail. Price higher, RSI lower, divergence screaming caution. Held off and sure enough the pullback came, but not before trapping all the threshold chasers. That avoidance saved me, but it created a new snag, overthinking. Started second-guessing every signal, which dragged trades out too long sometimes. Like in 2020, during that wild volatility from the pandemic news, market whipping around. RSI at 30 on an index looked like a buy. Divergence agreed on the daily but clashed on the hourly. I froze, missed the entry, and watched it run without me. That hesitation stemmed from all the prior traps, you see. If one divergence had fooled me before, why trust this one? Took time to balance it, realizing the twice check wasn't about perfection but cutting the noise. And that noise builds on itself. I knew this guy once, traded similar stuff, always glued to RSI levels like gospel. He quit after a bad streak in the crypto dip. Yes, I dabbled there occasionally, same principles applied. He sold at 70 on some coin, it mooned further, and that broke him. Made me reflect on my own close calls, how ignoring the momentum layer kept pulling me into those. But slowly incorporating the twice approach, levels first, divergence second, started smoothing things. Not overnight, mind you. There was this oil stock during the energy crunch, news hitting left and right. RSI over 70, but no divergence, momentum strong. I stayed in, rode it up, but only because I'd learned from the crashes where divergence would have signaled the top earlier. If I hadn't connected those dots from the bear markets, I'd have exited too soon, left money on the table. This unfolding kept going through the long sideways years, those stretches where nothing moves big. Market in 2015 or so, just range-bound forever. RSI bouncing between 30 and 70 like a yo-yo, giving signals that fizzled every time. I got caught in a few, buying lows that sank further because the overall momentum was dead. That boredom thought hit me then, not during panic, just staring at flat lines. Maybe RSI shines more in trends, less in chops. Led to using it twice in context, checking if the broader market had divergence too, not just the stock. Skipped a lot of noise that way, but it fed into another quiet issue, patience wearing thin. Waiting for both layers to align meant fewer trades, and in those dull years, that felt like missing out, even when it saved skin. If that patience had cracked earlier, who knows, might have chased more hype. Like during the meme stock frenzy, everything irrational. RSI on one of those hit 70, crowds buying anyway. Divergence was wild, price up but indicator diverging down hard. I sat out, watched others get burned when it collapsed. That restraint came from all the chained mistakes before. If the dot-com hadn't stung, if 2008 hadn't reinforced, I might have jumped in. But it did, and that shifted how I handled the fakes. Still, even with the twice secret, things slip. Had a recent index trade, S&P again, RSI at 30 during a dip. Levels said buy, divergence said wait, momentum not bottoming yet. Ignored my own rule for a second, entered early, got stopped out. Small loss, but it reminded me how the problems loop if you don't stay vigilant. That slip happened because of overconfidence from prior wins, see. One good streak makes you think you've cracked it, then bam, back to basics. And basics evolve quietly. I heard an interview once, some trader talking about how indicators like RSI are tools, not crystal balls, and it lined up with what I'd observed in my logs over decades. No big revelation, just confirmation that the momentum angle, the divergences, turned the simple use into something twice as useful. Applied it during the crypto swings I touched, Bitcoin or whatever, RSI over 70 in a bull run, but divergence showing weakness. Sold, avoided the drop, but only because I'd blown up ignoring that before. If those early tech trades hadn't chained into the crash lessons, I might still be threshold bound. This whole mess of experiences piles up, doesn't it? One ignored divergence leads to a bad habit, that habit to missed opportunities, those misses to overcorrections. Slowly untangling it meant revisiting trades from bull runs where RSI levels worked half the time, but adding the twice check bumped it. Like in the post-pandemic boom, stocks flying, RSI 70 didn't mean sell if momentum held, no divergence. Stayed long, profited, but that win tied back to the bear market scars where divergence saved exits. Without those connections, it'd all feel random still. Even now, it doesn't end clean. Had a trade last month, utility stock during some rate news. RSI 30, buy signal, divergence neutral. Entered it chopped, broke even. Not a disaster, but it showed how the layers interact. If news hadn't aligned, divergence might have warned off. That uncertainty lingers, keeps you sharp, or wears you down depending. If any of this rings a bell from your own slips, you might stick around the channel. I check comments more than you'd guess, See if others have similar twice moments. Subscribe if these raw recollections help sort your head a bit. It's funny how it all loops back, never quite resolved. You think you've got the indicator tamed, then a new cycle throws a curve. Keeps it real, I suppose.